观众朋友们，大家好。目前呢，2024年的第一个财报季已经进入了尾声。根据 FactSet 最新的数据显示，已经有超过80%的标普500公司发布了他们的企业财报，其中有75%的公司盈利是超出了市场的预期。这个数值低于5年平均水平77%，但是呢，要高于10年的平均水平74%。与此同时，在11个板块中，有7个板块报告了超出预期的盈利，其中呢以通信、非必需消费为首。另外呢，有4个板块是报告了低于预期的这个盈利水平，其中呢以金融板块为首。今天我们再次走进纳斯达克，全球第2大交易所，专访他们的 IR Intelligence Team Principal Chris Anselmo， 请他来谈一谈对于本季财报季的一些解读以及分析。Hello, Chris.
Hello.Thank
you so much for accepting our interview.
Yeah, thank you for having me.
So good to see you. So the first question, because you are the principal of Nasdaq's IR intelligence team, how does your team analyze and interpret this macroeconomic situation environment right now?
Sure. So we have a multitude of different software and people-based services here at Nasdaq in our IR intelligence division. So what we're doing is we're working with corporate issuers and telling them what's happening in the markets, uncovering trends. The tool that I use to analyze a lot of activity recently ahead of this interview was IR Insight, which is our software solution. It's able to aggregate all sorts of different transcripts and earnings releases from publicly issued companies. It also has access to over 2,000 brokers, so we're able to read the best-in-class research across the world.
So right now, how is the macroeconomic trends influencing these financial seasons?
Sure. So rates are top of mind, as you can imagine. The expectation right now is that rates will start coming down in June or July, maybe about 100 basis points this year. So we've seen the markets rise recently to all-time highs. Due to the expectation that rates will come down, but also because we're seeing tremendous growth in corporate earnings. We have nearly 5% growth across the market. We have low volatility, and this is contributing to the stock price appreciation throughout the market. The challenge that we're seeing, though, is that the stock price appreciation has been focused on a select group of companies, and the breadth in the market is the worst it's been in years.
Right, because based on recent economic data such as the CPI and the PPI, they indicate that inflation in the US is still very sticky. However, the market consensus is that 2024 is the year when the Federal Reserve will start cutting interest rates. It's not a question about if they will do it, it's a question about how many times and to what point. So how do you interpret the monetary policy influence on companies' earnings as well as investors' sentiment?
Great. So what we're seeing is, as I mentioned, the expectation, and you said that the expectation is rates will start coming down this year. Mm-hmm. So lower rates creates an environment that's easier for corporate earnings to grow. It reduces the cost of capital, and it also allows both the corporate issuer as well as the consumer to spend more money, and that's an easier growth environment for the markets.
Mm-hmm. Based on current market valuations and investors' behavior, do you think technology sector right now is experiencing a bubble, just like what we have experienced in the 2000 internet bubble?
So, when we define a bubble, it's a rapid rise in valuation followed by a rapid decline. So what we'd focus on is the sustainability of the current valuations. And right now, what we're seeing is a path to sustainability for these tech companies. You have tremendous growth currently going on with corporate earnings. We're seeing analysts put their estimates for the S&P 500, which will be, that continues the high. So the market isn't anticipating any sort of decline in price appreciation or growth. So there is a sustainable, path forward. We are hearing, challenges around, around valuation being stretched in the market, as well as some soft guidance going forward. But the expectation right now, due to the potential for future growth as well as a lower rate environment, isn't anticipating a bubble to pop, if you will.
So what are some of the key indicators or tools that your teams are using to assess whether a technology sector is in bubble or not?
Sure. So we're looking at investor sentiment. We're looking at the Fed rate policy and when the monetary policy could change. We're looking and aggregating all sorts of different commentary that we're seeing in corporate earnings releases. We're seeing a rise in the companies using the terminology artificial intelligence. A lot of those, when we speak about the breadth in the market, the companies related to artificial intelligence are the ones that are outperforming. We're seeing a rise in just the terminology of artificial intelligence, as well as operational efficiencies that this artificial intelligence would create. We're seeing that across all the market, not just in semiconductors that build the chips to power the artificial intelligence, but all sorts of different companies are understanding that are trying to take advantage of that wave and that trend so that they can be on the winning side of artificial intelligence. The challenge that we're seeing too is that when you think about corporates using the terminology efficiency, operational efficiency, this could be in relation to layoffs as well. And the Fed is keeping a close eye on the job markets on future Fed policy. So there is a huge focus on the strength of the job market and how that's impacted by potential layoffs, either that we see going forward.
So you just mentioned artificial intelligence. AI is a very strong sector in this financial earnings season. So based on your observation, can you identify any sectors or industries that have showed particularly strong or weak performance during this specific financial earnings season?
Sure. We're seeing tremendous growth in tech companies, in communication companies, consumer discretionary. These are the same type of companies that are going to benefit in a low interest rate environment because of that ability to increase spending to create growth, as well as the consumer able to continue spending around that. So yes, that would be the area that we're seeing a lot of growth in. Conversely, we're not seeing as much growth in energy and healthcare due to oil prices, as well as hospital utilization and rising labor costs.
Mm-hmm. So besides the macroeconomic factors, are there any other underlying factors are driving these trends?
What we're looking for is the company's ability to increase their future earnings. Mm-hmm. So there's a lot of commentary around guidance and how the stocks, how they believe that their future earnings will occur. And we're keeping a close eye on those projections, trying to see where things change and pivot going forward. I think the really great thing that we're starting to see in the market is that for the first time in years, we're not projecting a recession, and investor sentiment is higher than it's been in a long time. So a lot of positives, but there are things that we're looking at that could be a challenge, that being the breadth of the market, as I mentioned earlier, as well as some of the sticky inflation data and geopolitical landscape are things in the strength of the job market that could be a bearish view on things.
Mm-hmm. So your job as the principal of Nasdaq's IR intelligence team, tell us about your daily responsibilities and how your team help companies navigate through these trends or challenges.
Sure. So I really enjoy my job. I've been doing it for 19 years, and what the crux of what we're doing is working hand in hand with our market intelligence desk, keeping companies up to date on these macro trends, but also keeping them up to date on what's happening with their stock, who's buying and selling, so that they can maximize the effectiveness and efficiencies of their investor relations program. So we're providing them tools as well as a consultation. We like to think that we're part of their team or an extension of their team, so that they are meeting with the right investors, understanding the appropriate messaging, understanding what's happening in their stock, whether it's different or the same with the broader macroeconomics and how those implications happen, and really have a deep understanding of the capital markets as well as competitive intelligence.
So you've been working at this role for like over the 19 years. That's a really long time. Yet, based on this financial earnings season, did you observe any particular trends that could indicate a longer shift in the US stock market?
Yeah, I've been able, sitting in a great seat to watch the capital markets over 19 years. And as I mentioned earlier, I think that the big shift is the positivity, right? There's a lot of uncertainty that has been removed from the market as far as will or won't we be in a recession. There's still a little bit of uncertainty around that, as well as uncertainty around the timing of rates, but the expectation continues to get lower, and we continue to remove that uncertainty in the market, and it's creating positivity. There's a lot of money on the sidelines that has been waiting to come back into the market once this uncertainty has been removed. So we're hopeful and excited that things could be turning around. The market's at all-time highs, so we could love to continue the march higher.
So which factor do you think is the biggest contributor to this positivity?
I think it's been a combination of resilient corporate earnings that have come in. I think we have over 80% of the companies have beat expectations from an earnings perspective. You have 5% growth looking across the market. You have a consumer that is very resilient and continues to see strength throughout the broader economic backdrop. We have a strong jobs market, and now we're threading the needle, so to speak, on interest rates, and hoping that we're expecting a lot of hawkish commentary, and potentially things may not move as quickly as some investors had hoped earlier as we price out future earning or future rate cuts. But at the end of the day, they will eventually start coming down, and that's going to provide an easier landscape for corporates to navigate, and as well as grow earnings.